through such transactions. During recent years, the second solution has been available to very few large companies. The exceptions have primarily been those companies in glamorous or promotional businesses to which the market temporarily attaches valuations at or above intrinsic business valuation. The third solution is for the acquirer to go ahead with the acquisition, but then subsequently repurchase a quantity of shares equal to the number issued by the merger. In this manner, what originally was a stock-for-stock merger can be converted effectively into a cash-for-stock acquisition. Repurchases of this kind are damage repair moves. Regular readers will correctly guess that we much prefer repurchases that directly enhance the wealth of owners instead of repurchases that merely repair previous damage. Scoring touchdowns is more exhilarating than recovering one's fumbles. But when a fumble has occurred, recovery is important, and we heartily recommend damage repair repurchases that turn a bad stock deal into a fair cash deal. The language utilized in mergers tends to confuse the issues and encourage irrational actions by managers. For example, dilution is usually carefully calculated on a pro forma basis for both book value and current earnings per share. Particular emphasis is given to the latter item. When that calculation is negative, dilutive from the acquiring company's standpoint, a justifying explanation will be made internally, if not elsewhere, that the lines will cross favorably at some point in the future. While deals often fail in practice, they never fail in projections. If the CEO is visibly painting over a prospective acquisition, subordinates and consultants will supply the requisite projections to rationalize any price. Should the calculation produce numbers that are immediately positive, that is, anti-dilutive for the acquirer, no comment is thought to be necessary. The attention given this form of dilution is overdone. Current earnings per share, or even earnings per share of the next few years, are an important variable in most business valuations, but far from all-powerful. There have been plenty of mergers, non-dilutive in this limited sense, that were instantly value-destroying for their acquirer. And some mergers that have diluted current and near-term earnings per share have in fact been value-enhancing. What really counts is whether a merger is dilutive or anti-dilutive in terms of intrinsic business value, a judgment involving consideration of many variables. We believe calculation of dilution from this viewpoint to be all-important and too seldom made. A second language problem relates to the equation of exchange. If Company A announces that it will issue shares to merge with Company B, the process is customarily described as Company A to acquire Company B, or B sells to A. Clear thinking about the matter would result if a more awkward but more accurate description were used. Part of A sold to acquire B, or owners of B to receive part of A in exchange for their properties. In a trade, what you are giving is just as important as what you are getting. This remains true even when the final tally on what is being given is delayed. Subsequent sales of common stock or convertible issues, either to complete the financing for a deal or to restore balance sheet strength, must be fully counted in evaluating the fundamental mathematics of the original acquisition. If corporate pregnancy is going to be the consequence of corporate mating, the time to face that fact is before the moment of ecstasy. Managers and directors might sharpen their thinking by asking themselves if they would sell 100% of their business on the same basis that they are being asked to sell part of it. And if it isn't smart to sell all on such a basis, they should ask themselves why it is smart to sell a portion. Accumulation of small managerial stupidities will produce a major stupidity, not a major triumph. Las Vegas has been built upon the wealth transfers that occur when people engage in seemingly small disadvantageous capital transactions. The giving versus getting factor can most easily be calculated in the case of registered investment companies. Assume investment company X, selling at 50% of asset value, wishes to merge with investment company Y. Assume also that Company X therefore decides to issue shares equal in market value to 100% of Y's asset value. Such a share exchange would leave X trading $2 of its previous intrinsic value for $1 of Y's intrinsic value. protests would promptly come forth from both excess shareholders and the SEC, which rules on the fairness of registered investment company mergers. Such a transaction simply would not be allowed. In the case of manufacturing, service, financial companies, etc., values are not normally as precisely calculable as in the case of investment companies. But we have seen mergers in these industries that just as dramatically destroyed value for the owners of the acquiring company as was the case in the hypothetical illustration above. This destruction could not happen if management and directors would assess the fairness of any transaction by using the same yardstick in the measurement of both businesses. Finally, a word should be said about the double whammy effect upon owners of the acquiring company when value-diluting stock issuances occur. Under such circumstances, the first blow is the loss of intrinsic business value that occurs through the merger itself. The second is the downward revision in market valuation that, quite rationally, is given to that now diluted business value. For current and prospective owners, understandably will not pay as much for assets lodged in the hands of a management that has a record of wealth destruction through unintelligent share issuances as they will pay for assets entrusted to a management with precisely equal operating talents, but a known distaste for anti-owner actions. Once management shows itself insensitive to the interests of owners, shareholders will suffer a long time from the price-to-value ratio afforded their stock relative to other stocks, no matter what assurances management gives that the value-diluting action taken was a one-of-a-kind event. Those assurances are treated by the market much as one bug-in-the-salad explanations are treated at restaurants. Such explanations, even when accompanied by a new waiter, do not eliminate a drop in the demand and hence market value for salads, both on the part of the offended customer and his neighbors pondering what to order. Other things being equal, the highest stock market prices relative to intrinsic business value are given to companies whose managers have demonstrated their unwillingness to issue shares at any time on terms unfavorable to the owners of the business. I've mentioned that we strongly prefer to use cash rather than Berkshire stock in acquisitions. A study of the record will tell you why. If you aggregate all of our stock-only mergers, excluding those we did with two affiliated companies, Diversified Retailing and Blue Chip Stamps, you will find that our shareholders are slightly worse off than they would have been had I not done the transactions. Though it hurts me to say it, when I've issued stock, I've cost you money. Be clear about one thing. This cost has not occurred because we were misled in any way by sellers or because they thereafter failed to manage with diligence and skill. On the contrary, the sellers were completely candid when we were negotiating our deals and have been energetic and effective ever since. Instead, our problem has been that we own a truly marvelous collection of businesses, which means that trading away a portion of them for something new almost never makes sense. When we issue shares in a merger, we reduce your ownership in all of our businesses, partly owned companies such as Coca-Cola and American Express, and all of our terrific operating companies as well. An example from sports will illustrate the difficulty we face. For a baseball team, acquiring a player who can be expected to bat .350 is almost always a wonderful event, except when the team must trade a .380 hitter to make the deal. Because our roster is filled with .380 hitters, we have tried to pay cash for acquisitions, and here our record has been far better. Starting with National Indemnity in 1967 and continuing with, among others, Seas, Buffalo News, Scott Fetzer, and Geico, we have acquired, for cash, a number of large businesses that have performed incredibly well since we bought them. These acquisitions have delivered Berkshire tremendous value, indeed far more than I anticipated when we made our purchases. We believe that it is almost impossible for us to trade up from our present businesses and managements. Our situation is the opposite of Camelot's Mordred, of whom Guinevere commented, "The one thing I can say for him is that he is bound to marry well. Everybody is above him." Marrying well is extremely difficult for Berkshire. In contemplating business mergers and acquisitions, many managers tend to focus on whether the transaction is immediately dilutive or anti-dilutive to earnings per share, or, at financial institutions, to per share book value. An emphasis of this sort carries great dangers. Imagine that a 25-year-old first-year MBA student is considering merging his future economic interests with those of a 25-year-old day laborer. The MBA student, a non-earner, would find that a share-for-share merger of his equity interest in himself with that of the day laborer would enhance his near-term earnings in a big way. But what could be sillier for the student than a deal of this kind? In corporate transactions, it's equally silly for the would-be purchaser to focus on current earnings when the prospective acquiree has either different prospects, a different mix of operating and non-operating assets, or a different capital structure. At Berkshire, we have rejected many merger and purchase opportunities that would have boosted current and near-term earnings, but that would have reduced per-share intrinsic value. Our approach, rather, has been to follow Wayne Gretzky's advice. Go to where the puck is going to be, not to where it is. As a result, our shareholders are now many billions of dollars richer than they would have been if we had used the standard catechism. The sad fact is that most major acquisitions display an egregious imbalance. They are a bonanza for the shareholders of the acquiree. They increase the income and status of the acquirer's management, and they are a honeypot for the investment bankers and other professionals on both sides. But alas, they usually reduce the wealth of the acquirer's shareholders, often to a substantial extent. That happens because the acquirer typically gives up more intrinsic value than it receives. Do that enough, says John Medlin, the retired head of Wachovia Corp., and you are running a chain letter in reverse. Over time, the skill with which a company's managers allocate capital has an enormous impact on the enterprise's value. Almost by definition, a really good business generates far more money, at least after its early years, than it can use internally. The company could, of course, distribute the money to shareholders by way of dividends or share repurchases. But often the CEO asks a strategic planning staff, consultants, or investment bankers whether an acquisition or two might make sense. That's like asking your interior decorator whether you need a $50,000 rug. The acquisition problem is often compounded by a biological bias. Many CEOs attain their positions in part because they possess an abundance of animal spirits and ego. If an executive is heavily endowed with these qualities, which, it should be acknowledged, sometimes have their advantages, they won't disappear when he reaches the top. When such a CEO is encouraged by his advisors to make deals, he responds much as would a teenage boy who is encouraged by his father to have a normal sex life. It's not a push he needs. Some years back, a CEO friend of mine, in jest it must be said, unintentionally described the pathology of many big deals. This friend, who ran a property casualty insurer, was explaining to his directors why he wanted to acquire a certain life insurance company. After droning rather unpersuasively through the economics and strategic rationale for the acquisition, he abruptly abandoned the script. With an impish look, he simply said, "Aw, fellas, all the other kids have one." At Berkshire, our managers will continue to earn extraordinary returns from what appear to be ordinary businesses. As a first step, these managers will look for ways to deploy their earnings advantageously in their businesses. What's left they will send to Charlie and me. We then will try to use those funds in ways that build per-share intrinsic value. Our goal will be to acquire either part or all of the business that we believe we understand, that have good, sustainable underlying economics, and that are run by managers whom we like, admire, and trust. Sensible share repurchases versus green mail. Our endorsement of repurchases is limited to those dictated by price-to-value relationships and does not extend to the green mail repurchase, a practice we find odious and repugnant. In these transactions, two parties achieve their personal ends by exploitation of an innocent and unconsulted third party. The players are 1. The shareholder, extortionist, who, even before the ink on his stock certificate dries, delivers his "your money or your life" message to managers. 2. The corporate insiders who quickly seek peace at any price as long as the price is paid by someone else. And 3. The shareholders whose money is used by 2 to make 1 go away. As the dust settles, the mugging, transient shareholder gives his speech on free enterprise, the muggy management gives its speech on the best interests of the company, and the innocent shareholder standing by mutely funds the payoff. Leveraged buyouts. If successful corporate business acquisition is so hard, how does one explain the widespread recent success of most of the leveraged buyout (LBO) operators who have purchased corporations? A huge part of the answer comes from income tax effects and other simple effects. When, in a typical LBO, the typical mostly equity corporate capitalization was replaced by 90% debt plus a new 10% of capitalization common stock position, 1. The combined market value of all the new common stock plus the new debt became much higher than the previous market value of all the older common stock because the existing stream of pre-tax earnings was no longer shared with corporate income tax collectors who, in many cases, had previously received more cash each year than shareholders. And 2. Even after the value-enhancing effect of the corporate tax reduction was shared with former shareholders by paying them extra high prices to leave, a retained residue of value-enhancing tax effect made the new common stock, which now became much like a speculative warrant with good terms, worth considerably more than cost as the ink dried on acquisition papers. And 3. The new owners then resorted to strategies difficult neither to conceive nor implement, including the following. A. They eliminated many of the easily removable costs, largely personnel costs, and subpar segments which in some mix, bedevil successful corporations, and including ours, with sloth and folly, and 2. Create their humane grace and, through present sacrifice, good long-term prospects, justifying sacrifice endured, and B. They sold off a few operations at super high prices, sometimes exercising the easiest microeconomic insight by selling to a direct competitor, and sometimes selling to a surprisingly easy-to-find non-competitive corporate buyer, not owned by its managers, willing to pay almost as high a price as the competitor would, and 4. The new owners then profited in due course not only from the tax effect and other simple reshuffling activities described above, but also from the wonderful upside effects of extreme financial leverage during a long business boom accompanied by a rising stock market. Whether the country wants a large number or even any of its large corporations to have extremely leveraged capitalizations, except through occasional adversity, presents interesting social questions. Is one social function of corporations to be financially strong so that they act as shock absorbers, protecting dependent employees, suppliers, and customers from part of the volatility implicit in capitalism? Was Ben Franklin right when he included the following folk wisdom in Poor Richard's Almanac? It is hard for an empty sack to stand upright. Is a weak corporation, borrowed to the hilt, the social equivalent of a bridge with an inadequate reserve of structural strength? Granting that leveraged buyouts have some favorable effects as well as unfavorable effects on long-term efficiency, how many thousands of able people do we wish to attract into promotional corporate recapitalization activity which, 1. Reduces corporate income taxes, 2. Often tests the limits of antitrust law, and 3. Focuses business attention on short-term cash generation to pay down oppressive levels of debt? Finally, as Columbia Law School's Professor Lou Lowenstein puts it, more or less, do we really want entire corporate businesses, as important social institutions, continuously traded like pork belly contracts? However the social questions are answered, 3 aspects of the present situation are clear. First, the corporate tax effect is so large in LBO transactions that easy success in such transactions does not imply that success is easy in ordinary corporate acquisitions. Second, the hordes of leveraged buyout operators now with us raise the general level of acquisition prices to the detriment of other would-be acquirers, including Wesco, which are not willing to maximize tax benefits through maximized borrowing. And third, the LBO operator will not go away so long as present permissive laws last. The operators have a real advantage under such laws, not just a fig leaf aiding promotion. Even though failure and disgrace will reduce their number and prices paid in leveraged buyout transactions will fall, the capitalized value of reducing the corporate income tax will remain. Therefore, plenty of rational incentive will remain for transactions. The LBO genie will encounter reverses, but he is not going back in the bottle unless ordered to do so by new laws. It should also be noted that the LBO operators' incentives to bid high do not end with real advantages derived from tax law and willingness to reshuffle businesses with much speed and few scruples. Additional incentives for high bids come from typical structures in which general partners of LBO partnerships risk little of their own money, often less than none after fees are taken into account, yet share significantly in gains. Such arrangements are similar to the system of the racetrack tout. And who has ever seen a tout who didn't want his backer to make a lot of bets? To Wesco, as a non-LBO operator, the good corporate acquisition game was always tough. And that game in each recent year has become more like fishing for muskies at Leech Lake in Minnesota, where the writer's earliest business partner, Ed Hoskins, had the following conversation with his Indian guide. "Are any muskies caught in this lake?" "More muskies are caught in this lake than in any other lake in Minnesota. This lake is famous for muskies." "How long have you been fishing here?" 19 years. "And how many muskies have you caught?" "None." When a management has our point of view, infrequency of business acquisition may safely be predicted. Whether this happens, as we like to believe, because the game is hard for almost everyone, or merely because the game is hard for us, the result for West Coast shareholders is the same: less worthwhile activity than we all would like. But there may be one consolation: a series of big, incorrectable acquisition troubles with no meaningful salvage is seldom caused by people who think the acquisition game is like fishing for muskies at Leech Lake. Sound acquisition policies. It may seem strange that we exult over a year in which we made 3 acquisitions, given that we have regularly used these pages to question the acquisition activities of most managers. Rest assured, Charlie and I haven't lost our skepticism. We believe most deals do damage to the shareholders of the acquiring company. Too often, the words from HMS Pinafore apply. Things are seldom what they seem. Skim milk masquerades as cream. Specifically, sellers and their representatives invariably present financial projections having more entertainment value than educational value. In the production of rosy scenarios, Wall Street can hold its own against Washington. In any case, why potential buyers even look at projection prepared by sellers baffles me. Charlie and I never give them a glance, but instead keep in mind the story of the man with an ailing horse. Visiting the vet, he said, "Can you help me? Sometimes my horse walks just fine and sometimes he limps." The vet's reply was pointed. "No problem. When he's walking fine, sell him." In the world of mergers and acquisitions, that horse would be peddled as secretariat. At Berkshire, we have all the difficulties in perceiving the future that other acquisition-minded companies do. Like them also, we face the inherent problem that the seller of a business practically always knows far more about it than the buyer and also picks the time of sale, a time when the business is likely to be walking just fine. Even so, we do have a few advantages, perhaps the greatest being that we don't have a strategic plan. Thus, we feel no need to proceed in an ordained direction, a course leading almost invariably to silly purchase prices, but can instead simply decide what makes sense for our owners. In doing that, we always mentally compare any move we are contemplating with dozens of other opportunities open to us, including the purchase of small pieces of the best businesses in the world via the stock market. Our practice of making this comparison, acquisitions against passive investments, is a discipline that managers focused simply on expansion seldom use. Talking to Time magazine a few years back, Peter Drucker got to the heart of things. "I will tell you a secret. Deal-making beats working. Deal-making is exciting and fun, and working is grubby. Running anything is primarily an enormous amount of grubby detail work. Deal making is romantic, sexy. That's why you have deals that make no sense. In making acquisitions, we have a further advantage. As payment, we can offer sellers a stock backed by an extraordinary collection of outstanding businesses. An individual or a family wishing to dispose of a single fine business, but also wishing to defer personal taxes indefinitely, is apt to find Berkshire stock a particularly comfortable holding. I believe, in fact, that this calculus played an important part in the 2 acquisitions for which we paid shares in 1995. Beyond that, sellers sometimes care about placing their companies in a corporate home that will both endure and provide pleasant, productive working conditions for their managers. Here again, Berkshire offers something special. Our managers operate with extraordinary autonomy. Additionally, our ownership structure enables sellers to know that when I say we are buying to keep, the promise means something. For our part, we like dealing with owners who care what happens to their companies and people. A buyer is likely to find fewer unpleasant surprises dealing with that type of seller than with one simply auctioning off his business. In addition to the foregoing being an explanation of our acquisition style, it is, of course, a not-so-subtle sales pitch. If you own or represent a business earning $75 million or more before tax and it fits the criteria set forth below, just give me a call. Our discussion will be confidential. And if you aren't interested now, file our proposition in the back of your mind. We are never going to lose our appetite for buying companies with good economics and excellent management. Concluding this little dissertation on acquisitions, I can't resist repeating a tale told me last year by a corporate executive. The business he grew up in was a fine one, with a long-time record of leadership in its industry. Its main product, however, was distressingly glamourless. So several decades ago, the company hired a management consultant who, naturally, advised diversification, the then-current fad. Focus was not yet in style. Before long, the company acquired a number of businesses, each after the consulting firm had gone through a long and expensive acquisition study. And the outcome? Said the executive sadly, "When we started, we were getting 100% of our earnings from the original business. After 10 years, we were getting 150%. It's discouraging to note that though we have on 4 occasions made major purchases of companies whose sellers were represented by prominent investment banks, we were in only one of these instances contacted by the investment bank. In the other 3 cases, I myself or a friend initiated the transaction at some point after the investment bank had solicited its own list of prospects. We would love to see an intermediary earn its fee by thinking of us and therefore repeat here what we're looking for. 1. Large purchases. 2. Demonstrated consistent earning power. Future projections are of no interest to us, nor are turnaround situations. 3. Businesses earning good returns on equity while employing little or no debt. 4. Management in place. We can't supply it. 5. Simple businesses. If there's lots of technology, we won't understand it. And 6. An offering price. We don't want to waste our time or that of the seller by talking, even preliminarily, about a transaction when price is unknown. We will not engage in unfriendly takeovers. We can promise complete confidentiality and a very fast answer, customarily within 5 minutes, as to whether we're interested. We prefer to buy for cash, but will consider issuing stock when we receive as much in intrinsic business value as we give. Our favorite form of purchase is one in which the company's owner-managers wish to generate significant amounts of cash, sometimes for themselves, but often for their families or inactive shareholders. At the same time, these managers wish to remain significant owners who continue to run their companies just as they have in the past. We think we offer a particularly good fit for owners with such objectives, and we invite potential sellers to check us out by contacting people with whom we have done business in the past. Charlie and I frequently get approached about acquisitions that don't come close to meeting our tests. We found that if you advertise an interest in buying collies, a lot of people will call hoping to sell you their Cocker Spaniels. A line from a country song expresses our feeling about new ventures, turnarounds, or auction-like sales. When the phone don't ring, you'll know it's me. On selling one's business. Most business owners spend the better part of their lifetimes building their businesses. By experience built upon endless repetition, they sharpen their skills in merchandising, purchasing, personnel selection, etc. It's a learning process, and mistakes made in one year often contribute to competence and success in succeeding years. In contrast, owner-managers sell their business only once, frequently in an emotionally charged atmosphere with a multitude of pressures coming from different directions. Often, much of the pressure comes from the brokers whose compensation is contingent upon consummation of a sale, regardless of its consequences for both buyer and seller. The fact that the decision is so important, both financially and personally, to the owner can make the process more, rather than less, prone to error. And mistakes made in the once-in-a-lifetime sale of a business are not reversible. Price is very important, but often is not the most critical aspect of the sale. You and your family have an extraordinary business, one of a kind in your field, and any buyer is going to recognize that. It's also a business that is going to get more valuable as the years go by. So if you decide not to sell now, you are very likely to realize more money later on. With that knowledge, you can deal from strength and take the time required to select the buyer you want. If you should decide to sell, I think Berkshire Hathaway offers some advantages that most other buyers do not. Practically all of these buyers will fall into one of two categories. 1. A company located elsewhere but operating in your business or in a business somewhat akin to yours. Such a buyer, no matter what promises are made, will usually have managers who feel they know how to run your business operations and, sooner or later, will want to apply some hands-on help. If the acquiring company is much larger, it often will have squads of managers recruited over the years in part by promises that they will get to run future acquisitions. They will have their own way of doing things, and, even though your business record undoubtedly will be far better than theirs, human nature will at some point cause them to believe that their methods of operating are superior. You and your family probably have friends who have sold their businesses to larger companies, and I suspect that their experiences will confirm the tendency of parent companies to take over the running of their subsidiaries, particularly when the parent knows the industry or thinks it does. 2. A financial maneuverer invariably operating with large amounts of borrowed money who plans to resell either to the public or to another corporation as soon as the time is favorable. Frequently, this buyer's major contribution will be to change accounting methods so that earnings can be presented in the most favorable light just prior to his bailing out. This sort of transaction is becoming much more frequent because of rising stock market and the great supply of funds available for such transactions. If the sole motive of the present owners is to cash their chips and put the business behind them, and plenty of sellers fall in this category, either type of buyer that I've just described is satisfactory. But if the seller's business represents the creative work of a lifetime and forms an integral part of their personality and sense of being, buyers of either type have serious flaws. Berkshire is another kind of buyer, a rather unusual one. We buy to keep, but we don't have and don't expect to have operating people in our parent organization. All of the businesses we own are run autonomously to an extraordinary degree. In most cases, the managers of important businesses we have owned for many years have not been to Omaha or even met each other. When we buy a business, the sellers go on running it just as they did before the sale. We adapt to their methods rather than vice versa. We have no one, family recently recruited MBAs, etc., to whom we have promised a chance to run businesses we have bought from owner-managers. And we won't have. You know of some of our past purchases. I'm enclosing a list of everyone from whom we have ever bought a business, and I invite you to check with them as to our performance versus our promises. You should be particularly interested in checking with the few whose businesses did not do well in order to ascertain how we behaved under difficult conditions. Any buyer will tell you that he needs you personally, and if he has any brains, he most certainly does need you. But a great many buyers, for the reasons we mentioned above, don't match their subsequent actions to their earlier words. We will behave exactly as promised, both because we have so promised and because we need to in order to achieve the best business results. This need explains why we would want the operating members of your family to retain a 20% interest in the business. We need 80% to consolidate earnings for tax purposes, which is a step important to us. It is equally important to us that the family members who run the business remain as owners. Very simply, we would not want to buy unless we felt key members of present management would stay on as our partners. Contracts cannot guarantee your continued interest. We would simply rely on your word. The areas I get involved in are capital allocation and selection and compensation of the top managers. Other personnel decisions, operating strategies, etc. are their bailiwick. Some Berkshire managers talk over some of their decisions with me, some don't. It depends upon their personalities and, to an extent, upon their own personal relationship with me. If you should decide to do business with Berkshire, we would pay in cash. Your business would not be used as collateral for any loan by Berkshire. There would be no brokers involved. Furthermore, there would be no chance that a deal would be announced and that the buyer would then back off or start suggesting adjustments, with apologies, of course, and with an explanation that banks, lawyers, boards of directors, etc. were to be blamed. And finally, you would know exactly with whom you are dealing. You would not have one executive negotiate the deal only to have someone else in charge a few years later, or have the president regretfully tell you that his board of directors required this change or that, or possibly required sale of your business to finance some new interest of the parents. It's only fair to tell you that you would be no richer after the sale than now. The ownership of your business already makes you wealthy and soundly invested. A sale would change the form of your wealth, but it wouldn't change its amount. If you sell, you will have exchanged a 100% owned valuable asset that you understand for another valuable asset, cash, that will probably be invested in small pieces, stocks, of other businesses that you understand less well. There is often a sound reason to sell, but if the transaction is a fair one, the reason is not so that the seller can become wealthier. I will not pester you. If you have any possible interest in selling, I would appreciate your call. I would be extraordinarily proud to have Berkshire, along with the key members of your family, own your company. I believe we would do very well financially, and I believe you would have just as much fun running the business over the next 20 years as you have had during the past 20. Sincerely, Warren E. Buffett. Our acquisitions usually develop as referrals from other managers who have sold to us in the past. At other companies, executives may devote themselves to pursuing acquisition possibilities with investment bankers, utilizing an auction process that has become standardized. In this exercise, the bankers prepare a book that makes me think of the Superman comics of my youth. In the Wall Street version, a formerly mild-mannered company emerges from the investment banker's phone booth able to leap over competitors in a single bound and with earnings moving faster than a speeding bullet. Titillated by the book's description of the acquiree's powers, acquisition-hungry CEOs, Lois Lanes, all beneath their cool exteriors, promptly swoon. What's particularly entertaining in these books is the precision with which earnings are projected for many years ahead. If you ask the author-banker, however, what his own firm will earn next month, he will go into a protective crouch and tell you that business and markets are far too uncertain for him to venture a forecast. Here's one story I can't resist relating. In 1985, a major investment banking house undertook to sell Scott Fetzer, offering it widely, but with no success. Upon reading of this strikeout, I wrote Ralph Sachet, Scott Fetzer's CEO, expressing an interest in buying the business. I had never met Ralph, but within a week we had a deal. Unfortunately, Scott Fetzer's letter of engagement in the banking firm provided it a $2.5 million fee upon sale, even if it had nothing to do with finding the buyer. I guess the lead banker felt he should do something for his payment, so he graciously offered us a copy of the book on Scott Fetzer that his firm had prepared. With his customary tact, Charlie responded, "I'll pay $2.5 million not to read it." At Berkshire, our carefully crafted acquisition strategy is simply to wait for the phone to ring. Happily, it sometimes does so, usually because a manager who sold to us earlier has recommended to a friend that he think about following suit. The buyer of choice. Two economic factors probably contributed to the rush of acquisition activity we experienced last year. First, many managers and owners foresaw near-term slowdowns in their businesses, and, in fact, we purchased several companies whose earnings will almost certainly decline this year from peaks they have reached in 1999 or 2000. The declines make no difference to us, given that we expect all of our business to now and then have ups and downs. Only in the sales presentations of investment banks do earnings move forever upward. We don't care about the bumps. What matters are the overall results. But the decisions of other people are sometimes affected by the near-term outlook, which can both spur sellers and temper the enthusiasm of purchasers who might otherwise compete with us. A second factor that helped us in 2000 was that the market for junk bonds dried up as the year progressed. In the two preceding years, junk bond purchasers had relaxed their standards, buying the obligations of ever weaker issuers at inappropriate prices. The effects of this laxity were felt last year in a ballooning of defaults. In this environment, financial buyers of businesses, those who wished to buy using only a sliver of equity, became unable to borrow all they thought they needed. What they could still borrow, moreover, came at a high price. Consequently, LBO operators became less aggressive in their bidding when businesses came up for sale last year. Because we analyze purchases on an all-equity basis, our evaluations did not change, which means we became considerably more competitive. Aside from the economic factors that benefited us, we now enjoy a major and growing advantage in making acquisitions in that we are often the buyer of choice for the seller. That fact, of course, doesn't assure a deal. Sellers have to like our price, and we have to like their business and management, but it does help. We find it meaningful when an owner cares about whom he sells to. We like to do business with someone who loves his company, not just the money that a sale will bring him, though we certainly understand why he likes that as well. When this emotional attachment exists, it signals that important qualities will likely be found within the business: honest accounting, pride of product, respect for customers, and a loyal group of associates having a strong sense of direction. The reverse is apt to be true also. When an owner auctions off his business, exhibiting a total lack of interest in what follows, you will frequently find that it has been dressed up for sale, particularly when the seller is a financial owner. And if owners behave with little regard for their business and its people, their conduct will often contaminate attitudes and practices throughout the company. When a business masterpiece has been created by a lifetime or several lifetimes of unstinting care and exceptional talent, it should be important to the owner what corporation is entrusted to carry on its history. Charlie and I believe Berkshire provides an almost unique home. We take our obligations to the people who created a business very seriously, and Berkshire's ownership structure ensures that we can fulfill our promises. When we tell John Justin that his business, Justin Industries, will remain headquartered in Fort Worth, or assure the Bridge family that its operation, Ben Bridge Jeweler, will not be merged with another jeweler, these sellers can take those promises to the bank. How much better it is for the painter of a business, Rembrandt, to personally select its permanent home than to have a trust officer or uninterested heirs auction it off. Throughout the years, we have had great experiences with those who recognize that truth and apply it to their business creations. We'll leave the auctions to others. Our long-avowed goal is to be the buyer of choice for businesses, particularly those built and owned by families. The way to achieve this goal is to deserve it. That means we must keep our promises, avoid leveraging up acquired businesses, grant unusual autonomy to our managers, and hold the purchased companies through thick and thin, though we prefer thick and thicker. Our record matches our rhetoric. Most buyers competing against us, however, follow a different path. For them, acquisitions are merchandise. Before the ink dries on their purchase contracts, these operators are contemplating exit strategies. We have a decided advantage, therefore, when we encounter sellers who truly care about the future of their businesses. Some years back, our competitors were known as leveraged buyout operators, but LBO became a bad name. So in Orwellian fashion, the buyout firms decided to change their moniker. What they did not change, though, were the essential ingredients of their previous operations, including their cherished fee structures and love of leverage. Their new label became private equity, a name that turns the facts upside down. A purchase of a business by these firms almost invariably results in dramatic reductions in the equity of portion of the acquiree's capital structure compared to that previously existing. A number of these acquirees, purchased only 2 to 3 years ago, are now in mortal danger because of the debt piled on them by their private equity buyers. Much of the bank debt is selling below 70 cents on the dollar, and the public debt has taken a far greater beating. The private equity firms, it should be noted, are not rushing in to inject the equity their wards now desperately need. Instead, they're keeping their remaining funds very private. In the regulated utility field, there are no large family-owned businesses. Here, Berkshire hopes to be the buyer of choice of regulators. It is they, rather than selling shareholders, who judge the fitness of purchasers when transactions are proposed. There is no hiding your history when you stand before these regulators. They can, and do, call their counterparts in other states when you operate and ask how you have behaved in respect to all aspects of the business, including a willingness to commit adequate equity capital. When MidAmerican proposed its purchase of Pacific Corp in 2005, regulators in the 6 new states we would be serving immediately checked our record in Iowa. They also carefully evaluated our financing plans and capabilities. We passed this examination just as we expect to pass future ones. We hope to buy more regulated utilities in the future, and we know that our business behavior in jurisdictions where we are operating today will determine how we are welcomed by new jurisdictions tomorrow. Valuation and accounting. To those of you who are uninterested in accounting, I apologize for this dissertation. I realize that many of you do not pore over figures, but instead hold Berkshire primarily because you know that 1. Charlie and I have the bulk of your money in Berkshire. 2. We intend to run things so that your gains or losses are in direct proportion to ours. 3. The record has so far been satisfactory. There is nothing necessarily wrong with this kind of faith approach to our investing. Other shareholders, however, prefer an analysis approach, and we want to supply the information they need. In our own investing, we search for situations in which both approaches give us the same answer. Aesop and inefficient Bush theory. The formula for valuing all assets that are purchased for financial gain has been unchanged since it was first laid out by a very smart man in about 600 BC, though he wasn't smart enough to know it was 600 BC. The oracle was Aesop, and his enduring, though somewhat incomplete, investment insight was a bird in the hand is worth 2 in the bush. To flesh out this principle, you must answer only 3 questions. How certain are you that there are indeed birds in the bush? When will they emerge, and how many will there be? What is the risk-free interest rate, which we consider to be the yield on long-term U.S. bonds? If you can answer these 3 questions, you will know the maximum value of the bush, and the maximum number of the birds you now possess that should be offered for it. And, of course, don't literally think birds, think dollars. Aesop's investment axiom, thus expanded and converted into dollars, is immutable. It applies to outlays for farms, oil royalties, bonds, stocks, lottery tickets, and manufacturing plants. And neither the advent of the steam engine, the harnessing of electricity, nor the creation of the automobile changed the formula one iota, nor will the internet. Just insert the correct numbers, and you can rank the attractiveness of all possible uses of capital throughout the universe. Common yardsticks, such as dividend yield, the ratio of price to earnings or to book value, and even growth rates have nothing to do with valuation except to the extent they provide clues to the amount and timing of cash flows into and from the business. Indeed, growth can destroy value if it requires cash inputs in the early years of a project or enterprise that exceed the discounted value of the cash that those assets will generate in later years. Market commentators and investment managers who glibly refer to growth and value styles as contrasting approaches to investment are displaying their ignorance, not their sophistication. Growth is simply a component, usually a plus, sometimes a minus, in the value of equation. Alas, though Aesop's proposition and the third variable, that is, interest rates, are simple, plugging in numbers for the other two variables is a difficult task. Using precise numbers is, in fact, foolish. Working with a range of possibilities is the better approach. Usually, the range must be so wide that no useful conclusion can be reached. Occasionally, though, even very conservative estimates about the future emergence of birds reveal that the price quoted is startlingly low in relation to value. Let's call this phenomenon the IBT, inefficient bush theory. To be sure, an investor needs some general understanding of business economics as well as the ability to think independently to reach a well-founded positive conclusion. But the investor does not need brilliance nor blinding insights. At the other extreme, there are many times when the most brilliant of investors can't muster a conviction about the birds to emerge, not even when a very broad range of estimates is employed. This kind of uncertainty frequently occurs when new businesses and rapidly changing industries are under examination. In cases of this sort, any capital commitment must be labeled speculative. Now, speculation, in which the focus is not on what an asset will produce, but rather on what the next fellow will pay for it, is neither illegal, immoral, nor un-American. But it is not a game in which Charlie and I wish to play. We bring nothing to the party, so why should we expect to take anything home? The line separating investment and speculation, which is never bright and clear, becomes blurred still further when most market participants have recently enjoyed triumphs. Nothing sedates rationality like large doses of effortless money. After a heady experience of that kind, normally sensible people will drift into behavior akin to that of Cinderella at the ball. They know that overstaying the festivities, that is, continuing to speculate in companies that have gigantic valuations relative to the cash they are likely to generate in the future, will eventually bring on pumpkins and mice. But they nevertheless hate to miss a single minute of what is one hell of a party. Therefore, the giddy participants all plan to leave just seconds before midnight. There's a problem, though. They are dancing in a room in which the clocks have no hands. Last year, we commented on the exuberance, and yes, it was irrational, that prevailed, noting the investor expectations had grown to be several multiples of probable returns. One piece of evidence came from a Payne-Weber-Gallup survey of investors conducted in December 1999, in which the participants were asked their opinion about the annual returns investors could expect to realize over the decade ahead. Their answers averaged 19%. That, for sure, was an irrational expectation. For American business as a whole, there couldn't possibly be enough birds in the 2009 bush to deliver such a return. Far more irrational still were the huge valuations that market participants were then putting on businesses almost certain to end up being of modest or no value. Yet investors, mesmerized by soaring stock prices and ignoring all else, piled into these enterprises. It was as if some virus, racing wildly among investment professionals as well as amateurs, induced hallucinations in which the values of stocks in certain sectors became decoupled from the values of the businesses that underlay them. This surreal scene was accompanied by much loose talk about value creation. We readily acknowledge that there has been a huge amount of true value created in the past decade by new or young businesses, and that there is much more to come. But value is destroyed, not created, by any business that loses money over its lifetime, no matter how high its interim valuation may get. What actually occurs in these cases is wealth transfer, often on a massive scale. By shamelessly merchandising birdless bushes, Promoters have in recent years moved billions of dollars from the pockets of the public to their own purses and to those of their friends and associates. The fact is that a bubble market has allowed the creation of bubble companies, entities designed more with an eye to making money off investors rather than for them. Too often, an IPO, not profits, was the primary goal of a company's promoters. At bottom, the business model for these companies has been the old-fashioned chain letter for which many fee-hungry investment bankers acted as eager postmen. But a pin lies in wait for every bubble. And when the two eventually meet, a new wave of investors learned some very old lessons. First, many in Wall Street, a community in which quality control is not prized, will sell investors anything they will buy. Second, speculation is most dangerous when it looks easiest. At Berkshire, we make no attempt to pick the few winners that will emerge from an ocean of unproven enterprises. We're not smart enough to do that, and we know it. Instead, we try to apply Aesop's 2,600-year-old equation to opportunities in which we have reasonable confidence as to how many birds are in the bush and when they will emerge, a formulation that my grandsons would probably update to, "A girl in a convertible is worth 5 in the phone book." Obviously, we can never precisely predict the timing of cash flows in and out of a business or their exact amount. We try, therefore, to keep our estimates conservative and to focus on industries where business surprises are unlikely to wreak havoc on owners. Even so, we make many mistakes. I'm the fellow, remember, who thought he understood the future economics of trading stamps, textiles, shoes, and second-tier department stores. Lately, the most promising bushes have been negotiated transactions for entire businesses, and that pleases us. You should clearly understand, however, that these acquisitions will at best provide us only reasonable returns. Really juicy results from negotiated deals can be anticipated only when capital markets are severely constrained and the whole business world is pessimistic. We are 180 degrees from that point. Intrinsic value, book value, and market price. Intrinsic value is an all-important concept that offers the only logical approach to evaluating the relative attractiveness of investments and businesses. Intrinsic value can be defined simply. It is the discounted value of the cash that can be taken out of a business during its remaining life. The calculation of intrinsic value, though, is not so simple. As our definition suggests, intrinsic value is an estimate rather than a precise figure, and it is additionally an estimate that must be changed if interest rates move or forecasts of future cash flows are revised. Two people looking at the same set of facts, moreover, and this would apply even to Charlie and me, will almost inevitably come up with at least slightly different intrinsic value figures. That is one reason we never give you our estimates of intrinsic value. What our annual reports do supply, though, are the facts that we ourselves use to calculate this value. Meanwhile, we regularly report our per-share book value, an easily calculable number, though one of limited use. The limitations do not arise from our holdings of marketable securities, which are carried on our books at their current prices. Rather, the inadequacies of book value have to do with the companies we control, whose values, as stated on our books, may be far different from their intrinsic values. The disparity can go in either direction. For example, in 1964, we could state with certitude that Berkshire's per-share book value was $19.46. However, that figure considerably overstated the company's intrinsic value, since all of the company's resources were tied up in a sub-profitable textile business. Our textile assets had neither going concern nor liquidation values equal to their carrying values. Today, however, Berkshire's situation is reversed. Our March 31, 1996 book value of $15,180 far understates Berkshire's intrinsic value, a point true because many of the businesses we control are worth much more than their carrying value. Inadequate though they are in telling the story, we give you Berkshire's book value figures because they today serve as a rough, albeit significantly understated, tracking measure for Berkshire's intrinsic value. In other words, the percentage change in book value in any given year is likely to be reasonably close to that year's change in intrinsic value. You can gain some insight into the differences between book value and intrinsic value by looking at one form of investment, a college education. Think of the education's cost as its book value. If this cost is to be accurate, it should include the earnings that were foregone by the student because he chose college rather than a job. For this exercise, we will ignore the important non-economic benefits of an education and focus strictly on its economic value. First, we must estimate the earnings that the graduate will receive over his lifetime and subtract from that figure an estimate of what he would have earned had he lacked his education. That gives us an excess of earnings figure, which must then be discounted and at an appropriate interest rate back to graduation day. The dollar result equals the intrinsic economic value of the education. Some graduates will find that the book value of their education exceeds its intrinsic value, which means that whoever paid for the education didn't get his money's worth. In other cases, the intrinsic value of an education will far exceed its book value, a result that proves capital was wisely deployed. In all cases, what is clear is that book value is meaningless as an indicator of intrinsic value. An interesting accounting irony overlays a comparison of the reported financial results of our controlled companies with those of the permanent minority holdings. These holdings have a market value of over $2 billion, yet they produced only $11 million in reported after-tax earnings for Berkshire in 1987. Accounting rules dictate that we take into income only the dividends these companies pay us, which are little more than nominal, rather than our share of the earnings, which in 1987 amounted to well over $100 million. On the other hand, accounting rules provide that the carrying value of these three holdings, owned as they are by insurance companies, must be recorded on our balance sheet at current market prices. The result, GAAP accounting, lets us reflect in our net worth the up-to-date underlying values of the businesses we partially own, but does not let us reflect their underlying earnings in our income account. In the case of our controlled companies, just the opposite is true. Here, we show full earnings in our income account, but never change asset values on our balance sheet, no matter how much the value of a business might have increased since we purchased it. Our mental approach to this accounting schizophrenia is to ignore GAAP figures and to focus solely on the future earning power of both our controlled and non-controlled businesses. Using this approach, we establish our own ideas of business value, keeping these independent from both the accounting values shown on our books for controlled companies and the values placed by a sometimes foolish market on our partially owned companies. It is this business value that we hope to increase at a reasonable or preferably unreasonable rate in the years ahead. Historically, Berkshire shares have sold modestly below intrinsic business value. With the price there, purchasers could be certain, as long as they did not experience a widening of this discount, that their personal investment experience would at least equal the financial experience of the business. But recently the discount has disappeared, and occasionally a modest premium has prevailed. The elimination of the discount means that Berkshire's market value increased even faster than business value, which itself grew at a pleasing pace. That was good news for any owner holding while that move took place, but it is bad news for the new or prospective owner. If the financial experience of new owners of Berkshire is merely to match the future financial experience of the company, any premium of market value over intrinsic business value that they pay must be maintained. Over the long term, there has been a more consistent relationship between Berkshire's market value and business value than has existed for any other publicly traded equity with which I am familiar. This is a tribute to you. Because you have been rational, interested, and investment-oriented, the market price for Berkshire stock has almost always been sensible. This unusual result has been achieved by a shareholder group with unusual demographics. Virtually all of our shareholders are individuals, not institutions. No other public company our size can claim the same. Ben Graham told a story 40 years ago that illustrates why investment professionals behave as they do. An oil prospector, moving to his heavenly reward, was met by St. Peter with bad news. "You're qualified for residence," said St. Peter, "but as you can see, the compound reserved for oilmen is packed. There's no way to squeeze you in." After thinking a moment, the prospector asked if he might say just 4 words to the present occupants. That seemed harmless to St. Peter, so the prospector cupped his hands and yelled, "Oil discovered in hell!" Immediately the gate to the compound opened, and all of the oilmen marched out to head for the nether regions. Impressed, St. Peter invited the prospector to move in and make himself comfortable. The prospector paused. "No," he said, "I think I'll go along with the rest of the boys. There might be some truth to that rumor after all." In the 1995 letter, with Berkshire shares selling at $36,000, I told you, 1. Berkshire's gain in market value in recent years had outstripped its gain in intrinsic value, even though the latter gain had been highly satisfactory. 2. That kind of overperformance could not continue indefinitely. And 3. Charlie and I did not at that moment consider Berkshire to be undervalued. Since I set down those cautions, Berkshire's intrinsic value has increased very significantly while the market price of our shares has changed little. This, of course, means that in 1996, Berkshire's stock underperformed the business. Consequently, today's price-to-value relationship is both much different from what it was a year ago and, as Charlie and I see it, more appropriate. Though our primary goal is to maximize the amount that our shareholders in total reap from their ownership of Berkshire, we wish also to maximize the benefits going to some shareholders at the expense of others. These are goals we would have were we managing a family partnership, and we believe they make equal sense for the manager of a public company. In a partnership, fairness requires that partnership interests be valued equitably when partners enter or exit. In a public company, fairness prevails when market price and intrinsic value are in sync. Obviously, they won't always meet that ideal, but a manager, by his policies and communications, can do much to foster equity. Of course, the longer a shareholder holds his shares, the more bearing Berkshire's business results will have on his financial experience, and the less it will matter what premium or discount to intrinsic value prevails when he buys and sells his stock. That's one reason we hope to attract owners with long-term horizons. Overall, I think we have succeeded in that pursuit. Berkshire probably ranks number 1 among large American corporations in the percentage of its shares held by owners with a long-term view. Calculations of intrinsic value, though all important, are necessarily imprecise and often seriously wrong. The more uncertain the future of a business, the more possibility there is that the calculation will be wildly off base. Here, Berkshire has some advantages: a wide variety of relatively stable earnings streams, combined with great liquidity and minimum debt. These factors mean that Berkshire's intrinsic value can be more precisely calculated than can the intrinsic value of most companies. Yet if precision is aided by Berkshire's financial characteristics, the job of calculating intrinsic value has been made more complex by the mere presence of so many earning streams. Back in 1965, when we owned only a small textile operation, the task of calculating intrinsic value was a snap. Now we own 68 distinct businesses with widely disparate operating and financial characteristics. This array of unrelated enterprises, coupled with our massive investment holdings, makes it impossible for you to simply examine our consolidated financial statements and arrive at an informed estimate of intrinsic value. We have attempted to ease this problem by clustering our businesses into 4 logical groups. These are insurance, chiefly Geico, Genry, and National Indemnity, regulated and capital-intensive businesses, like Berkshire Hathaway Energy and BNSF Railway, manufacturing, service, and retailing operations, which cover the waterfront, and finance and financial products, especially Extra, CORT, and Clayton Homes. Of course, the value of Berkshire may be either greater or less than the sum of these 4 parts. The outcome depends on whether our many units function better or worse by being part of a larger enterprise, and whether capital allocation improves or deteriorates when it is under the direction of a holding company. In other words, does Berkshire ownership bring anything to the party, or would our shareholders be better off if they directly owned shares in each of our 68 businesses? These are important questions, but ones that you will have to answer for yourself. Let's review two sets of figures that show where we've come from and where we are now. The first set is the amount of investments, including cash and cash equivalents, we own on a per-share basis. In making this calculation, we exclude investments held in our finance operation because these are largely offset by borrowings. Compound growth rate from 1965 to 2005 is 28%. Compound growth rate from 1995 to 2005 is 13%. In addition to these marketable securities, which with minor exceptions are held in our insurance company, we own a wide variety of non-insurance businesses. Below, we show the pre-tax earnings excluding goodwill amortization of these businesses, again on a per-share basis. Compound growth rate from 1965 to 2005 is 17.2%, and compound growth rate from 1995 to 2005 is 30.2%. When growth rates are under discussion, it will pay you to be suspicious as to why the beginning and terminal years have been selected. If either year was aberrational, any calculation of growth will be distorted. In particular, a base year in which earnings were poor can produce a breathtaking but meaningless growth rate. In the table above, however, the base year of 1965 was abnormally good. Berkshire earned more money in that year than it did in all but one of the previous 10. As you can see from the two tables, the comparative growth rates of Berkshire's two elements of value have changed in the last decade, a result reflecting our ever-increasing emphasis on business acquisitions. Nevertheless, Charlie and I want to increase the figures in both tables. Look through earnings. When one company owns part of another company, appropriate accounting procedures pertaining to that ownership interest must be selected from one of three major categories. The percentage of voting stock that is owned, in large part, determines which category of accounting principles should be utilized. Generally accepted accounting principles require, subject to exceptions naturally, full consolidation of sales, expenses, taxes, and earnings of business holdings more than 50% owned. Blue chip stamps, 60% owned by Berkshire Hathaway Inc., falls into this category. Therefore, all blue chip income and expense items are included in full in Berkshire's consolidated statement of earnings, with the 40% ownership interest of others in blue chip's net earnings reflected in the statement as a deduction for minority interest. Full inclusion of underlying earnings from another class of holdings companies owned 20% to 50%, usually called investees, also normally occurs. Earnings from such companies, for example Westco Financial, controlled by Berkshire but only 48% owned, are included via a one-line entry in the owner's statement of earnings. Unlike the over 50% category, all items of revenue and expense are omitted. Just the proportional share of net income is included. Thus, if Corporation A owns 1/3 of Corporation B, 1/3 of Corporation B's earnings, whether or not distributed by B, will end up in A's earnings. There are some modifications, both in this and the over 50% category, for intercorporate taxes and purchase price adjustments, the explanation of which we will save for a later day. We know you can hardly wait. Finally come holdings representing less than 20% of ownership of another company's voting securities. In these cases, accounting rules dictate that the owning companies include in their earnings only dividends received from such holdings. Undistributed earnings are ignored. Thus, should we own 10% of Corporation X with earnings of $10 million in 1980, we would report in our earnings, ignoring relatively minor taxes on intercorporate dividends, either A, $1 million if X declared the full $10 million in dividends, B, $500,000 if X paid out 50% or $5 million in dividends, or C, 0 if X reinvested all earnings. We impose this short and oversimplified course in accounting upon you because Berkshire's concentration of resources in the insurance field produces a corresponding concentration of its assets in companies in that third, less than 20% owned, category. Many of these companies pay out relatively small proportions of their earnings in dividends. This means that only a small proportion of their current earning power is recorded in our own current operating earnings. But while our reported operating earnings reflect only the dividends received from such companies, our economic well-being is determined by their earnings, not their dividends. Our holdings in this third category of companies have increased dramatically in recent years as our insurance businesses has prospered and securities markets have presented particularly attractive opportunities in the common stock area. The large increase in such holdings, plus the growth of earnings experienced by those partially owned companies, has produced an unusual result. The part of our earnings that these companies retained last year, the part not paid to us in dividends, exceeded the total reported annual operating earnings of Berkshire Hathaway. Thus, conventional accounting only allows less than half of our earnings iceberg to appear over the surface in plain view. Within the corporate world, such a result is quite rare. In our case, it is likely to be recurring. Our own analysis of earnings reality differs somewhat from generally accepted accounting principles, particularly when those principles must be applied in a world of high and uncertain rates of inflation. But it's much easier to criticize than to improve such accounting rules. The inherent problems are monumental. We have owned 100% of businesses whose reported earnings were not worth close to 100 cents on the dollar to us, even though, in an accounting sense, we totally controlled their disposition. The control was theoretical. Unless we reinvested all earnings, massive deterioration in the value of assets already in place would occur. But those reinvested earnings had no prospect of earning anything close to a market return on capital. We have also owned small fractions of businesses with extraordinary reinvestment possibilities, whose retained earnings had an economic value to us far in excess of 100 cents on the dollar. The value to Berkshire Hathaway of retained earnings is not determined by whether we own 100%, 50%, 20%, or 1% of the businesses in which they reside. Rather, the value of those retained earnings is determined by the use to which they are put and the subsequent level of earnings produced by that usage. This is true whether we determine the usage or whether managers we did not hire but did elect to join determine that usage. It's the act that counts, not the actors. And the value is in no way affected by the inclusion or non-inclusion of those retained earnings in our own reported operating earnings. If a tree grows in a forest partially owned by us, but we don't record the growth in our financial statements, we still own part of the tree. Our view, we warn you, is non-conventional. But we would rather have earnings for which we did not get accounting credit put to good use in a 10% owned company by a management we did not personally hire, than have earnings for which we did not get credit put into projects of more dubious potential by another management, even if we are that management. The term earnings has a precise ring to it, and when an earnings figure is accompanied by an unqualified auditor's certificate, a naive reader might think it comparable in certain to pi calculated to dozens of decimal places. In reality, however, earnings can be as pliable as putty when a charlatan heads the company reporting them. Eventually truth will surface, but in the meantime a lot of money can change hands. Indeed, some important American fortunes have been created by the monetization of accounting mirages. Berkshire's own reported earnings are misleading in a different but important way. We have huge investments in companies, investees, whose earnings far exceed their dividends and in which we record our share of earnings only to the extent of the dividends we receive. The extreme case is Capital Cities ABC, Inc. Our 17% share of the company's earnings amounted to more than $83 million last year, yet only about $530,000, $600,000 of dividends it paid us, less some $70,000 of tax, is counted in Berkshire's GAAP earnings. The residual $82 million plus stayed with Cap Cities as retained earnings, which work for our benefit but go unrecorded on our books. Our perspective on such forgotten but not gone earnings is simple. The way they are accounted for is of no importance, but their ownership and subsequent utilization is all important. We care not whether the auditors hear a tree fall in the forest. We do care who owns the tree and what's next done with it. When Coca-Cola uses retained earnings to repurchase its shares, the company increases our percentage ownership in what I regard to be the most valuable franchise in the world. Coke also, of course, uses retained earnings in many other value-enhancing ways. Instead of repurchasing stock, Coca-Cola would pay those funds to us in dividends, which we would then use to purchase more Coke shares. That would be a less efficient scenario. Because of taxes we would pay on dividend income, we would not be able to increase our proportionate ownership to the degree that Coke can, acting for us. If this less efficient procedure were followed, however, Berkshire would report far greater earnings. I believe the best way to think about our earnings is in terms of look-through results, calculated as follows. Take $250 million, which is roughly our share of the 1990 operating earnings retained by our investees, subtract $30 million for the incremental taxes we would have owed had that $250 million been paid to us in dividends, and add the remainder, $220 million, to our reported operating earnings of $371 million. Thus, our 1990 look-through earnings were about $590 million. In our view, the value to all owners of the retained earnings of a business enterprise is determined by the effectiveness with which those earnings are used, and not by the size of one's ownership percentage. If you have owned 0.01 of 1% of Berkshire during the past decade, you have benefited economically in full measure from your share of our retained earnings, no matter what your accounting system. Proportionately, you have done just as well if you had owned the magic 20%. But if you have owned 100% of a great many capital-intensive businesses during the decade, retained earnings that were credited fully and with painstaking precision to you under standard accounting methods have resulted in minor or zero economic value. This is not a criticism of accounting procedures. We would not like to have the job of designing a better system. It's simply to say that managers and investors alike must understand that accounting numbers are the beginning, not the end, of business valuation. In most corporations, less than 20% ownership positions are unimportant, perhaps in part because they prevent maximization of cherished reported earnings, and the distinction between accounting and economic results we have just discussed matters little. But in our own case, such positions are of very large and growing importance. Their magnitude, we believe, is what makes our reported operating earnings figure of limited significance. Within the gigantic auction arena composed of the entire array of major American corporations, it is our job to select businesses with economic characteristics allowing each dollar of retained earnings to be translated eventually into at least $1 of market value. Despite a lot of mistakes, we have so far achieved this goal. In doing so, we have been greatly assisted by Arthur Oaken's patron saint for economists, Saint Offset. In some cases, that is, retained earnings attributable to our ownership position have had insignificant or even negative impact on market value, while in other major positions a dollar retained by an investee corporation has been translated into $2 or more of market value. To date, our corporate overachievers have more than offset the laggards. If we can continue this record, it will validate our efforts to maximize economic earnings, regardless of the impact upon accounting earnings. We also believe that investors can benefit by focusing on their own look-through earnings. To calculate these, they should determine the underlying earnings attributable to the shares they hold in their portfolio and total these. The goal of each investor should be to create a portfolio, in effect a company, that will deliver him or her the highest possible look-through earnings a decade or so from now. An approach of this kind will force the investor to think about long-term business prospects rather than short-term stock market prospects, a perspective likely to improve results. It's true, of course, that in the long run, the scoreboard for investment decisions is market price. But prices will be determined by future earnings. In investing, just as in baseball, to put runs on the scoreboard, one must watch the playing field, not the scoreboard. The primary test of managerial economic performance is the achievement of a high earnings rate on equity capital employed without undue leverage, accounting gimmickry, etc., and not the achievement of consistent gains in earnings per share. In our view, many businesses would be better understood by their shareholder owners as well as the general public if managements and financial analysts modified the primary emphasis they place upon earnings per share and upon yearly changes in that figure. Economic versus accounting goodwill. Our intrinsic business value considerably exceeds book value. There are two major reasons. One, standard accounting principles require that common stocks held by our insurance subsidiaries be stated on our books at market value, but that other stocks we own be carried at the lower of aggregate cost or market. At the end of 1983, the market value of this latter group exceeded carrying value by $70 million pre-tax, or about $50 million after tax. This excess belongs in our intrinsic business value, but is not included in the calculation of book value. And two, more important, we own several businesses that possess economic goodwill, which is properly includable in intrinsic business value, far larger than the accounting goodwill that is carried on our balance sheet and reflected in book value. You can live a full and rewarding life without ever thinking about goodwill and its amortization. But students of investment and management should understand the nuances of the subject. My own thinking has changed drastically from 35 years ago when I was taught to favor tangible assets and to shun businesses whose value depended largely upon economic goodwill. This bias caused me to make many important business mistakes of omission, although relatively few of commission. Keynes identified my problem. The difficulty lies not in the new ideas, but in escaping from the old ones. My escape was long delayed, in part because most of what I had been taught by the same teacher had been, and continues to be, so extraordinarily valuable. Ultimately, business experience, direct and vicarious, produced my present strong preference for businesses that possess large amounts of enduring goodwill and that utilize a minimum of tangible assets. I recommend the following essay to those who are comfortable with accounting terminology and who have an interest in understanding the business aspects of goodwill. Whether or not you wish to tackle the essay, you should be aware that Charlie and I believe that Berkshire possesses very significant economic goodwill value above that reflected in our book value. The following discussion deals only with economic and accounting goodwill, not the goodwill of everyday usage. For example, a business may be well liked, even loved, by most of its customers but possess no economic goodwill. AT&T, before the breakup, was generally well thought of but possessed not a dime of economic goodwill. And regrettably, a business may be disliked by its customers but possess substantial and growing economic goodwill. So, just for the moment, forget emotions and focus only on economics and accounting. When a business is purchased, accounting principles require that the purchase price first be assigned to the fair value of the identifiable assets that are acquired. Frequently, the sum of the fair values put on the assets after the deduction of liabilities is less than the total purchase price of the business. In that case, the difference is assigned to an asset entitled excess of cost over equity in net assets required. To avoid constant repetition of this mouthful, we will substitute goodwill. Accounting goodwill arising from businesses purchased before November 1970 has a special standing. Except under rare circumstances, it can remain an asset on the balance sheet as long as the business bought is retained. That means no amortization charges to gradually extinguish that asset need to be made against earnings. The case is different, however, with purchases made from November 1970 on. When these create goodwill, it must be amortized over not more than 40 years through charges of equal amounts in every year to the earnings account. Since 40 years is the maximum period allowed, 40 years is what managements, including us, usually elect. That's how accounting goodwill works. To see how it differs from economic reality, let's look at an example close at hand. We'll round some figures and greatly oversimplify to make the example easier to follow. We'll also mention some implications for investor and manager. Blue Chip Stamps bought See's Candy early in 1972 for $25 million, at which time See's had about $8 million of net tangible assets. Throughout this discussion, accounts receivable will be classified as tangible assets, a definition proper for business analysis. This level of tangible assets was adequate to conduct the business without use of debt, except for short periods seasonally. See's was earning about $2 million after tax at the time, and such earnings seemed conservatively representative of future earning power in constant 1972 dollars. Thus, our first lesson. Businesses logically are worth far more than net tangible assets when they can be expected to produce earnings on such assets considerably in excess of market rates of return. The capitalized value of this excess return is economic goodwill. In 1972 and now, relatively few businesses could be expected to consistently earn the 25% after tax on net tangible assets that was earned by See's, doing it, furthermore, with conservative accounting and no financial leverage. It was not the fair market value of the inventories, receivables, or fixed assets that produced the premium rates of return. Rather, it was a combination of intangible assets, particularly a pervasive favorable reputation with consumers based upon countless pleasant experiences they have had with both product and personnel. Such a reputation creates a consumer franchise that allows the value of the product to the purchaser rather than its production cost to be the major determinant of selling price. Consumer franchises are a prime source of economic goodwill. Other sources include governmental franchises not subject to profit regulation, such as television stations, and an enduring position as the low-cost producer in an industry. Let's return to the accounting in the See's example. Blue Chip's purchase of See's at $17 million over net tangible assets required that a goodwill account of this amount be established as an asset of Blue Chip's books and that $425,000 be charged to income annually for 40 years to amortize that asset. By 1983, after 11 years of such charges, the $17 million had been reduced to about $12.5 million. Berkshire, meanwhile, owned 60% of Blue Chip and, therefore, also 60% of See's. This ownership meant that Berkshire's balance sheet reflected 60% of See's goodwill, or about $7.5 million. In 1983, Berkshire acquired the rest of Blue Chip in a merger that required purchase accounting as contrasted to the pooling treatment allowed for some mergers. Under purchase accounting, the fair value of the shares we gave to or paid Blue Chip holders had to be spread over the net assets acquired from Blue Chip. This fair value was measured, as it is almost always when public companies use their shares to make acquisitions, by the market value of the shares given up. The assets purchased consisted of 40% of everything owned by Blue Chip. As noted, Berkshire already owned the other 60%. What Berkshire paid was more than the net identifiable assets we received by $51.7 million, and was assigned to two pieces of goodwill, $28.4 million to See's Candy and $23.3 million to Buffalo Evening News. After the merger, therefore, Berkshire was left with a goodwill asset for See's that had two components: the $7.5 million remaining from the 1971 purchase, and $28.4 million newly created by the 40% purchased in 1983. Our amortization charge now will be about $1.0 million for the next 28 years and $0.7 million for the following 12 years, 2002 through 2013. In other words, different purchase dates and prices have given us vastly different asset values and amortization charges for two pieces of the same asset. We repeat our usual disclaimer: we have no better accounting system to suggest. The problems to be dealt with are mind-boggling and require arbitrary rules. But what are the economic realities? One reality is that the amortization charges that have been deducted as costs in the earnings statement each year since acquisition of Seas were not true economic costs. We know that because Seas last year earned $13 million after taxes on about $20 million of net tangible assets, a performance indicating the existence of economic goodwill far larger than the total original cost of our accounting goodwill. In other words, while accounting goodwill regularly decreased from the moment of purchase, economic goodwill increased in irregular but very substantial fashion. Another reality is that annual amortization charges in the future will not correspond to economic costs. It is possible, of course, that C's economic goodwill will disappear, but it won't shrink in even decrements or anything remotely resembling them. What is more likely is that the goodwill will increase in current, if not in constant, dollars because of inflation. That probably exists because true economic goodwill tends to rise in nominal value proportionally with inflation. To illustrate how this works, let's contrast a C's kind of business with a more mundane business. When we purchased C's in 1972, it will be recalled, it was earning about $2 million on $8 million of net tangible assets. Let us assume that our hypothetical mundane business then had $2 million of earnings also, but needed $18 million in net tangible assets for normal operations. Earning only 11% on required tangible assets, that mundane business would possess little or no economic goodwill. A business like that, therefore, might well have sold for the value of its net tangible assets, or for $18 million. In contrast, we paid $25 million for C's, even though it had no more in earnings and less than half as much in honest-to-God assets. Could less really have been more, as our purchase price implied? The answer is yes, even if both businesses were expected to have flat unit volume, as long as you anticipated, as we did in 1972, a world of continuous inflation. To understand why, imagine the effect that a doubling of the price level would subsequently have on the two businesses. Both would need to double their nominal earnings to $4 million to keep themselves even with inflation. This would seem to be no great trick, just sell the same number of units at double earlier prices and, assuming profit margins remain unchanged, profits also must double. But crucially, to bring that about, both businesses probably would have to double their nominal investment in net tangible assets, since that is the kind of economic requirement that inflation usually imposes on businesses, both good and bad. A doubling of dollar sales means correspondingly more dollars must be employed immediately in receivables and inventories. Dollars employed in fixed assets will respond more slowly to inflation, but probably just as surely. And all of this inflation-required investment will produce no improvement in rate of return. The motivation for this investment is the survival of the business, not the prosperity of the owner. Remember, however, that C's had net tangible assets of only $8 million. So it would only have had to commit an additional $8 million to finance the capital needs imposed by inflation. The mundane business, meanwhile, had a burden over twice as large, a need for $18 million of additional capital. After the dust had settled, the mundane business, now earning $4 million annually, might still be worth the value of its tangible assets, or $36 million. That means its owners would have gained only $1 of nominal value for every new dollar invested. This is the same dollar-for-dollar result they would have achieved if they had added money to a savings account. C's, however, also earning $4 million, might be worth $50 million if valued, as it logically would be, on the same basis as it was at the time of our purchase. So it would have gained $25 million in nominal value while the owners were putting up only $8 million in additional capital over $3 of nominal value gained for each $1 invested. Remember, even so, that the owners of the C's kind of business were forced by inflation to ante up $8 million in additional capital just to stay even in real profits. Any unleveraged business that requires some net tangible assets to operate, and almost all do, is hurt by inflation. Businesses needing little in the way of tangible assets simply are hurt the least. And the fact, of course, has been hard for many people to grasp. For years, the traditional wisdom, long on tradition, short on wisdom, held that inflation protection was best provided by businesses laden with natural resources, plants and machinery, or other tangible assets, in God we trust. It doesn't work that way. Asset-heavy businesses generally earn low rates of return, rates that often barely provide enough capital to fund the inflationary needs of the existing business, with nothing left over for real growth, for distribution to owners, or for acquisition of new businesses. In contrast, a disproportionate number of the great business fortunes built up during the inflationary years arose from ownership of operations that combined intangibles of lasting value with relatively minor requirements for tangible assets. In such cases, earnings have bounded upward in nominal dollars, and these dollars have been largely available for the acquisition of additional businesses. This phenomenon has been particularly evident in the communications business. That business has required little in the way of tangible investment, yet its franchises have endured. During inflation, goodwill is the gift that keeps giving. But that statement applies, naturally, only to true economic goodwill. Spurious accounting goodwill, and there is plenty of it around, is another matter. When an overexcited management purchases a business at a silly price, the same accounting niceties described earlier are observed. Because it can't go anywhere else, the silliness ends up in the goodwill account. Considering the lack of managerial discipline that created the account, under such circumstances it might better be labeled no-will. Whatever the term, the 40-year ritual typically is observed, and the adrenaline so capitalized remains on the books as an asset, just as if the acquisition had been a sensible one. If you cling to any belief that accounting treatment of goodwill is the best measure of economic reality, I suggest one final item to ponder. Assume a company with $20 per share of net worth, all tangible assets. Further assume the company has internally developed some magnificent consumer franchise, or that it was fortunate enough to obtain some important television stations by original FCC grant. Therefore, it earns a great deal on tangible assets, say $5 per share, or 25%. With such economics, it might sell for $100 per share or more, and it might well also bring that price in a negotiated sale of the entire business. Assume an investor buys the stock at $100 per share, paying in effect $80 per share for goodwill, just as would a corporate purchaser buying the whole company. Should the investor impute a $2 per share amortization charge annually, $80 divided by 40 years, to calculate true earnings per share? And if so, should the new true earnings of $3 per share cause him to rethink his purchase price? We believe managers and investors alike should view intangible assets from two perspectives. 1. An analysis of operating results, that is, in evaluating the underlying economics of a business unit, amortization charges should be ignored. What a business can be expected to earn on unleveraged net tangible assets, excluding any charges against earnings for amortization of goodwill, is the best guide to the economic attractiveness of the operation. It is also the best guide to the current value of the operation's economic goodwill. 2. In evaluating the wisdom of business acquisitions, amortization charges should be ignored also. They should be deducted neither from earnings nor from the cost of the business. This means forever viewing purchased goodwill at its full cost before any amortization. Furthermore, cost should be defined as including the full intrinsic business value, not just the recorded accounting value, of all consideration given, irrespective of market prices of the securities involved at the time of merger and irrespective of whether pooling treatment was allowed. For example, what we truly paid in the Blue Chip merger for 40% of the goodwill of Seas and the News was considerably more than the $51.7 million entered on our books. This disparity exists because the market value of the Berkshire shares given up in the merger was less than their intrinsic business value, which is the value that defines the true cost to us. Operations that appear to be winners based upon perspective, 1, may pale when viewed from perspective, 2. A good business is not always a good purchase, although it's a good place to look for one. When Berkshire buys a business for a premium over the GAAP net worth of the acquiree, as will usually be the case, since most companies we want to buy don't come at a discount, that premium has to be entered on the asset side of our balance sheet. There are loads of rules about just how a company should record the premium. But to simplify this discussion, we will focus on goodwill, the asset item to which almost all of Berkshire's acquisition premiums have been allocated. For example, when we recently acquired the half of Geico we didn't previously own, we recorded goodwill of about $1.6 billion. GAAP requires goodwill to be amortized, that is, written off, over a period no longer than 40 years. Therefore, to extinguish our $1.6 billion in Geico goodwill, we will annually take charges of about $40 million against our earnings. In an accounting sense, consequently, our Geico goodwill will disappear gradually in even-sized bites. But the one thing I can guarantee you is that the economic goodwill we have purchased at Geico will not decline in the same measured way. In fact, my best guess is that the economic goodwill assignable to Geico will not decline at all, but rather will increase, and probably in a very substantial way. I made a similar statement in our 1983 annual report about the goodwill attributed to See's Candy when I used that company as an example in a discussion of goodwill accounting. At that time, our balance sheet carried about $36 million of See's goodwill. We have since been charging about $1 million against earnings every year in order to amortize the asset, and the See's goodwill on our balance sheet is now down to about $23 million. In other words, from an accounting standpoint, See's is now presented as having lost a good deal of goodwill since 1983. The economic facts could not be more different. In 1983, See's earned about $27 million pre-tax on $11 million of net operating assets. In 1995, it earned $50 million on only $5 million of net operating assets. Clearly, See's economic goodwill has increased dramatically during the interval rather than decreased. Just as clearly, See's is worth many hundreds of millions of dollars more than its stated value on our books. We could, of course, be wrong, but we expect Geico's gradual loss of accounting value to be paired with increases in its economic value. Certainly that has been the pattern at most of our subsidiaries, not just See's. That is why we regularly present our operating earnings in a way that allows you to ignore all purchase accounting adjustments. In the future, also, we will adopt a similar policy for look-through earnings, moving to a form of presentation that rids these earnings of the major purchase accounting adjustments of investees. We will not apply this policy to companies that have only small amounts of goodwill on their books, such as Coca-Cola. We will extend it, however, to Wells Fargo, which recently made huge acquisitions and consequently dealing with exceptionally large goodwill charges. Before leaving this subject, we should issue an important warning. Investors are often led astray by CEOs and Wall Street analysts who equate depreciation charges with the amortization charges we have just discussed. In no way are the two the same. With rare exceptions, depreciation is an economic cost every bit as real as wages, materials, or taxes. Certainly that is true at Berkshire and at virtually all the other businesses we have studied. Furthermore, we do not think so-called EBITDA, earnings before interest, taxes, depreciation, and amortization, is a meaningful measure of performance. Managements that dismiss the importance of depreciation and emphasize cash flow, or EBITDA, are apt to make faulty decisions, and you should keep that in mind as you make your own investment decisions. The application of accounting to acquisitions is currently a very contentious topic, and, before the dust settles, Congress may even intervene, a truly terrible idea. When a company is acquired, generally accepted accounting principles, GAAP, currently condone two very different ways of recording the transaction: purchase and pooling. In a pooling, stock must be the currency. In a purchase, payment can be made in either cash or stock. Whatever the currency, managements usually detest purchase accounting because it almost always requires that a goodwill account be established and subsequently written off, a process that saddles earnings with a large annual charge that normally persists for decades. In contrast, pooling avoids a goodwill account, which is why management loves it. Now, the Financial Accounting Standards Board, FASB, has proposed an end to pooling, and many CEOs are girdling for battle. It will be an important fight, so we'll venture some opinions. To begin with, we agree that the many managers who argue that goodwill amortization charges are usually spurious. For accounting rules to mandate amortization that will, in the usual case, conflict with reality is deeply troublesome. Most accounting charges relate to what's going on, even if they don't precisely measure it. As an example, depreciation charges can't with precision calibrate the decline in value that physical assets suffer, but these charges do at least describe something that is truly occurring. Physical assets invariably deteriorate. Correspondingly, obsolescence charges for inventories, bad debt charges for receivables, and accruals for warranties are among the charges that reflect true costs. The annual charges for these expenses can't be exactly measured, but the necessity for estimating them is obvious. In contrast, economic goodwill does not, in many cases, diminish. Indeed, in a great many instances, perhaps most, it actually grows in value over time. In character, economic goodwill is much like land. The value of both assets is sure to fluctuate, but the direction in which value is going to go is in no way ordained. At seas, for example, economic goodwill has grown in an irregular but very substantial manner for 78 years. And if we run the business right, growth of that kind will probably continue for at least another 78 years. To escape from the fiction of goodwill charges, managers embrace the fiction of pooling. This accounting convention is grounded in the poetic notion that when two rivers merge, their streams become indistinguishable. Under this concept, a company that has been merged into a larger enterprise has not been purchased, even though it will often have received a large sellout premium. Consequently, no goodwill is created, and those pesky subsequent charges to earnings are eliminated. Instead, the accounting for the ongoing entity is handled as if the businesses had forever been one unit. So much for poetry. The reality of merging is usually far different. There is indisputably an acquirer and an acquiree, and the latter has been purchased, no matter how the deal has been structured. If you think otherwise, just ask employees severed from their jobs which company was the conqueror and which was the conquered. You will find no confusion. So on this point, the FASB is correct. In most mergers, a purchase has been made. Yes, there are some true mergers of equals, but they are few and far between. Charlie and I believe there's a reality-based approach that should both satisfy the FASB, which correctly wishes to record a purchase, and meet the objections of managements to nonsensical charges for diminution of goodwill. We would first have the acquiring company record its purchase price, whether paid in stock or cash, at fair value. In most cases, this procedure would create a large asset representing economic goodwill. We would then leave this asset on the books, not requiring its amortization. Later, if the economic goodwill became impaired, as it sometimes would, it would be written down just as would any other asset judged to be impaired. If our proposed rule were to be adopted, it should be applied retroactively so that acquisition accounting would be consistent throughout America, a far cry from what exists today. One prediction: if this plan were to take effect, managements would structure acquisitions more sensibly, deciding whether to use cash or stock based on the real consequences for their shareholders rather than on the unreal consequences for their reported earnings. Owner earnings and the cash flow fallacy. Many business acquisitions require major purchase price accounting adjustments as described by Generally Accepted Accounting Principles, GAAP. The GAAP figures, of course, are the ones used in our consolidated financial statements. But, in our view, the GAAP figures are not necessarily the most useful ones for investors or managers. Therefore, the figures shown for specific operating units are earnings before purchase price adjustments are taken into account. In effect, these are the earnings that would have been reported by the businesses if we had not purchased them. A discussion of our reasons for preferring this form of presentation follows. It will never substitute for a steamy novel and definitely is not required reading. However, I know that among our shareholders there are those who are thrilled by my essays on accounting, and I hope that both of you enjoy it. First, a short quiz. Below are abbreviated 1986 statements of earnings for two companies. Which business is the more valuable? In column Company O, revenues are $677,240, and net income is $40,231. Company N has the same revenues, but the net income is only $28,605. As you've probably guessed, companies O and N are the same business, Scott Fetzer. In the O for old column, we have shown what the company's 1986 GAAP earnings would have been if we had not purchased it. In the N for new column, we have shown Scott Fetzer's GAAP earnings as actually reported by Berkshire. It should be emphasized that the two columns depict identical economics, i.e. the same sales, wages, taxes, etc. And both companies generate the same amount of cash for owners. Only the accounting is different. So, fellow philosophers, which column presents truth? Upon which set of numbers should managers and investors focus? Before we tackle those questions, let's look at what produces the disparity between O and N. We will simplify our discussion in some respects, but the simplification should not produce any inaccuracies in analysis or conclusions. The contrast between O and N comes about because we paid an amount for Scott Fetzer that was different from its stated net worth. Under GAAP, such differences, such premiums or discounts, must be accounted for by purchase price adjustments. In Scott Fetzer's case, we paid $315 million for net assets that were carried on its books at $172.4 million. So we paid a premium of $142.6 million. The first step in accounting for any premium paid is to adjust the carrying value of current assets to current values. In practice, this requirement usually does not affect receivables, which are roughly carried at current value, but often affects inventories. Because of a $22.9 million LIFO reserve and other accounting intricacies, Scott Fetzer's inventory account was carried at a $37.3 million discount from current value. So, making our first accounting move, we used $37.3 million of our $142.6 million premium to increase the carrying value of the inventory. Assuming any premium is left after current assets are adjusted, the next step is to adjust fixed assets to current value. In our case, this adjustment also required a few accounting acrobatics related to deferred taxes. Since this has been billed as a simplified discussion, I will skip the details and give you the bottom line. $68 million was added to fixed assets and $13 million was eliminated from deferred tax liabilities. After making this $81 million adjustment, we were left with $24.3 million of premium to allocate. Had our situation called for them, two steps would next have been required: the adjustment of intangible assets other than goodwill to current fair values, and the restatement of liabilities to current fair values, a requirement that typically affects only long-term debt and unfunded pension liabilities. In Scott Fetzer's case, however, neither of these steps was necessary. The final accounting adjustment we needed to make after recording fair market values for all assets and liabilities was the assignment of the residual premium to goodwill, technically known as excess of cost over the fair value of net assets acquired. This residual amounted to $24.3 million. Thus, the balance sheet of Scott Fetzer immediately before the acquisition, which is summarized below in column O, was transformed by the purchase into the balance sheet shown in column N. In real terms, both balance sheets depict the same assets and liabilities, but, as you can see, certain figures differ significantly. In column O, assets total $362,347, liabilities total $362,347, but in column N, assets and liabilities total $491,989. The higher balance sheet figures shown in column N produce the lower income figures shown in column N of the earnings statement presented earlier. This is the result of the asset write-ups and of the fact that some of the written-up assets must be depreciated or amortized. The higher the asset figure, the higher the annual depreciation or amortization charge to earnings must be. The charges that flowed to the earnings statement because of the balance sheet write-ups were numbered in the statement of earnings shown earlier. 1. $4,979,000 for non-cash inventory costs resulting primarily from reductions that Scott Fetzer made in its inventories during 1986. Charges of this kind are apt to be small or non-existent in future years. 2. $5,054,000 for extra depreciation attributable to the write-up of fixed assets. A charge approximating this amount will probably be made annually for 12 more years. 3. $595,000 for amortization of goodwill. This charge will be made annually for 39 more years in a slightly larger amount because our purchase was made on January 6 and, therefore, the 1986 figure applies to only 98% of the year. 4. $998,000 for deferred tax acrobatics that are beyond my ability to explain briefly, or perhaps even non-briefly. A charge approximating this amount will probably be made annually for 12 more years. By the end of 1986, the difference between the net worth of the old and new Scott Fetzer had been reduced from $142.6 million to $131 million by means of the extra $11.6 million that was charged to earnings of the new entity. As the years go by, similar charges to earnings will cause most of the premium to disappear, and the two balance sheets will converge. However, the higher land values and most of the higher inventory values that were established on the new balance sheet will remain unless land is disposed of or inventory levels are further reduced. What does all this mean for owners? Did the shareholders of Berkshire buy a business that earned $40.2 million in 1986, or did they buy one earning $28.6 million? Were those $11.6 million of new charges a real economic cost to us? Should investors pay more for the stock of Company O than of Company N? And, if a business is worth some given multiple of earnings, was Scott Fetzer worth considerably more the day before we bought it than it was worth the following day? If we think through these questions, we can gain some insights about what may be called owner earnings. These represent A. Reported earnings plus B. Depreciation, depletion, amortization, and certain other non-cash charges such as Company N's items 1 and 4 less C. The average annual amount of capitalized expenditures for plant and equipment, etc., that the business requires to fully maintain its long-term competitive position and its unit volume. If the business requires additional working capital to maintain its competitive position and unit volume, the increment also should be included in C. However, business